It's been a pretty heavy week in terms of the macroeconomic calendar. Tanvee Gupta Jain, India economist at Macquarie Securities, now joins in on the show. Tanvee, great to have you with us. I want to talk about some of the data that we got in earlier this week, the CPI numbers, and they ticked to a higher 8.6%, largely driven by the food prices. Do you think that when it comes to the growth inflation balance, it's still tilted toward growth?
If you look at the CPI inflation, I think inflation continues to be the most dominant concern, be it for growth front for the policymakers, because if inflation is still running at 8.6% and there is a possibility that we will have an El Nino induced adverse impact in monsoons, I think the adverse impact on growth because of high cost of capital shall continue. So I would say at this point, I would say inflation is the single most important concern for policymakers versus growth, which has already decelerated to, a decade low of 4.7%, which we are estimating for FY14.
We certainly can't ignore the impact of the El Nino on inflation going forward. How worried do you really think one should be?
See, as a house, we are seeing a more than 60% probability of El Nino actually panning out in 2014 monsoon season. If it actually pans out, especially for the growth front, I see 20 to 40 basis point downside to my GDP growth number of 5.4%. I am currently estimating a 2.9% agricultural GDP growth for FY15. For inflation, considering that 50% of the basket is food in CPI, it will have an impact, but yes, we need to wait for the spatial and the temporal distribution of rainfall to have a view on how it will impact inflation. But definitely, I do see upside risk to inflation going forward just because of bad monsoons, possibly because of El Nino panning out.
Tanvee, what kind of a bearing, if not actually then on sentiment, would the geopolitical tensions have? Because I hear a lot of voices speak about how the uncertainty on crude has increased manifold, and it will be difficult to gauge as to which way crude would move in the near term.
See, uncertainty definitely has a lot more bearing, especially for the global commodity prices, say crude oil, because India imports 80% of the crude oil requirement, and so far everyone was happy with global commodity prices trending lower because of slowdown in China, and crude oil prices have been pretty contained. But yes, if tomorrow, because of geopolitical tensions, we do see crude prices inching up, it will have a negative impact both for inflation as well as for the current account deficit. Both of these have been the macro stability risk which India was struggling hard, to justify since the last year, post the Fed announcements in May 2013. So I would believe for the geopolitical tensions, I think India will remain on the limelight regarding its impact.
Now, Tanvee, if the exit polls are proved correct, the government formation is going to be fairly straightforward, but we're still battling sticky inflation, fiscal concerns, slowing growth. How do you see the overall macros changing, if at all, the exit poll outcome is proven right?
Okay, so exit polls are indicating that we might get a strong and a stable government. If we're looking at, we might not be seeing a weak coalition, but definitely a stronger government. Now we need to realize that, even if the new government comes into place, we don't have any magic wand. India has been facing problems, be it macro stability risk, be it slowdown in growth, be it the capex cycle, completely at the bottom. But the thing is that at least the sentiment that the future course of action over the medium term will be optimistic, that will give strength to the economy. So even if with the change in government, my near-term growth estimates shall remain the same, but I will be more confident from the next 2 to 3 year, time horizon regarding India's ability to go back again to 6.5% kind of growth, which we are seeing over the past couple of years have been very difficult to achieve. Especially on the concerns which you just mentioned.
Carry on.
Okay, especially on the concerns which you just mentioned, I guess that post-elections, the budget which is getting announced in July will be the key thing to watch, because that will give you a sense what the new government tries to do, because achieving a fiscal deficit target by cutting down development spending is not something we would like to look forward to.
Okay, tell me what kind of a bearing could the currency appreciation have? Because I hear a lot. What's your base case for the currency? Because I hear a lot of voices say, at least on the equity side, say that if indeed there is the projected NDA government at the center, the amount of money that will come in over the next 3 months would be unprecedented for the markets, which is an FI investment and FDI investment as well coming in. So keeping that in mind, what's your base case for the currency?
Okay. If you look at according to the real effective exchange rate model, I think the fair value of rupee according to all that modeling exercise which we do is somewhere around 59.60. However, if we get a very strong NDA government coming into power and we see a very strong FI sentiment improvement and people are much more optimistic and we see FDI inflows increasing manifold, then there is a likelihood that you will see 3 to 5% appreciation in the currency in the short term. However, we at the same time need to realize that RBI won't have a choice but to rebuild the foreign exchange reserves, and at the same time we cannot afford a very strong currency because the entire growth, recovery in FY14 in FY15 versus FY14 is based on external demand. The moment you see currency appreciating, you will see it will start hurting our export growth. So I would say my base case for rupee will continue to be somewhere in the range of 59.60. Short-term rally will be there, but I don't see that sustaining for long. I would prefer RBI intervening, rebuild forex reserves, which are needed because we are living in a times of global risk aversion, and there is a possibility of that during the course of the year you see EM capital outflows concern again starts emerging across the world.
Tanvee, as if the week wasn't hectic enough, tomorrow the WPI inflation numbers for the month of April will be declared. The consensus range is between 5.3 to 6.2%, and the ET Now poll is suggesting a number of 5.7%. What is it that you're expecting, and do you think it's going to be a market-moving event or ignored completely like the rest of the data?
Okay, for WPI, my number is at 5.8, pricing in some minor increase, especially because of the food price inflation which we saw in the CPI. But to be very frank, now for policy purposes, it's the CPI which matters most. So we continue to focus on CPI, and I think the market right now is so much optimistic about the polling of the results on May, counting of the results on May 16, that I don't see market will be really moving with respect to this data point. But I think it should be very close to the consensus. 5.7 is the consensus, we're at 5.8.
Yeah, see, the other point that I wanted to make is sure enough that this could be closer to consensus, but if I were to ask this question to you tomorrow after the number is out, would you be more bearish on the inflation numbers for the next 3 months? I think you hinted at that at the start of the interview, but just wanted a bit of a detailed answer there. Would you be more bearish on the inflation numbers from the next 3 months perspective?
So my view on inflation is that be it CPI, be it WPI, especially in case of CPI, we are seeing a very strong base effect which is coming from the month of November, from the month of June till the month of November. So June to November you will see headline inflation moderating. However, what I am most concerned about is the core number, be it core WPI or core CPI. The point is, if you look at the numbers, core CPI is still at 7.7, core WPI has been inching slightly upwards every month. Right now is at 3.5%. According to my simulation exercise, even for the next 12 months, I don't see core CPI going below 7%. If that is the scenario, and the point is the moment domestic demand recovers, the pricing power will come back to the system because the output gap has narrowed. So the inflation concerns will continue to haunt us, and that is something which RBI is concerned about, and that we have the next policy review on June 3rd, and I see very difficult for the RBI, to nudge rates any longer to support the economy because they have to take care of inflation. So inflation is the single most concern which I am worried as of now looking at the entire macro for India.
Take us through how you see the overall liquidity situation shaping up post the elections, because some are of the view that if we do get a stable government, FI inflows could be the highest ever for India.
See, liquidity, if you have to look at, it's a two-way scenario. One, you have to see the credit deposit mismatch and the daily LAP balances, and the second is if you keep on seeing the FI liquidity, FI inflows coming in, then definitely if RBI even is intervening, you will see a liquidity supply increasing in the system. But my view is that because right now the temporary mismatch is so high that we will continue to see liquidity in the -1% of net demand in time liabilities, at least for the next near-term months. And plus we have the fiscal situation coming up, the borrowing calendar, the government spending. I think all of these will continue to put pressure on the liquidity scenario. So while there will be some respite from the good FI liquid, money coming in, but we need to see the deposit growth of the banks picking up for the sustained revival in liquidity.